morning, good afternoon, or good evening, and namaste to all of those from which part you're dialing in today. I think I heard we had over 80 countries joining in, so thank you, Ben, for coming in. Welcome to this final session focused on navigating the regulatory imperatives. 20 was meant ESG, with UK hosting COP26, the first global stocktake since the Paris Agreement. And the EU had finally agreed the outlines of the eagerly awaited taxonomy, and green bond being issued in increasingly large volumes. The ACT has been playing with their annual conference around ESG, with the message of balancing risk and championing sustainable growth. We're signatories to the Green Finance Education Charter, and we provide thought leadership through our publications and events, as well as participating at various conferences. Now, working group focused on ESG, and if anyone would like to join, please drop an email to technical@treasures.org. Since the start of the year, and it would be good to know what impact this has had. Have we moved from deal or no deal, or to a completely new game show like Le Juste Prix, or have we simply changed the background and moved to some deadlines? Has COVID-19 low industrial activity easier to achieve? Are lower oil prices a good thing or a bad thing from an ESG perspective? Well, to help us make sense of all of this, I'm joined by Mike Wilkins from S&P Global Ratings. We'll take us through where we've got to and how COVID-19 may impact the goal to being neutral by 2050. Before we get going, some housekeeping. If I hear a fire alarm, I'm out of here and the screen goes blank. Q&A, please submit questions via the Q&A box just above the session window if you're joining via the or on the app at the Q&A button at the bottom left. The session is being recorded and proceedings will be made available soon after we finish. And there's a virtual discussion forum which allows you to continue the discussion throughout the rest of the day today and tomorrow. And please stay engaged with the ACT on social media. We've got active LinkedIn groups, and we can follow us on Twitter at ACT Update and tweet using tag ACTITD. Now, Mike is an MD at S&P Global Ratings and has global responsibility for the firm's sustainable finance and analytical activities, including environment and climate risk research. At S&P, he spent 7 years as global infrastructure finance covering Europe, the Middle East, and Africa. Joined the firm in 1994 and has worked in London and Hong Kong. Mike, over to you.
So this is a presentation around the EU's drive for carbon neutrality by 2050. So we'll be talking about the EU Green Deal and the ambitions to reduce greenhouse gas emissions so that the 28 member states reach a point where we'll be net zero by 2050, and how that could be impacted by COVID-19 and the pandemic. So those are the topics of discussion. Let's go to the next slide, please. So the key messages that I want to leave you with are really related to a paper that we published a couple of weeks ago, which is really around how we think the EU's long-term climate goals to tackle climate change will remain unchanged despite the pandemic. And that's also despite the fact that there will be, we believe, some delays required to implement some of these climate goals, given that governments face undue pressure from the economic fallout related to COVID-19. Secondly, we believe that there will be some pressure, considerable pressure, in fact, from some carbon-intensive sectors, such as automotives and aviation in the transportation area, to push back on some of these climate policies, especially in relation to the timing and also the stringency of these measures, given the cost implications and the fact that some of these industries are facing, in many cases, unprecedented financial distress. And thirdly, we think, despite all this pressure, we think that there will be considerable easing of some of the longer-term requirements for demand for carbon-intensive goods and services as a result of changing consumer habits, such as working from home and less travel and commuting, and other sort of areas where you would see the environmental benefits come through, which may indeed lead to the ambitions of the EU actually being easier to achieve. So those are the key points. If we can move to the next slide, please. For those of you not familiar with the EU Green Deal, just by way of background, this is a legislative proposal by the European Commission, which basically entails a 1 trillion euro spend as part of the Sustainable Europe Investment Plan over the next decade. But part of that actually is related to the goals to achieve carbon neutrality or climate neutrality by 2050. And as part of that, the targets were related to reductions in greenhouse gas emissions, which are largely seen to be the cause of climate change. We've seen those targets being ratcheted upwards. So from a minimum requirement of 20% at the moment by 2020, we're going to see the current target of minus 40% ratcheted up to minus 50% by 2030. So this is going to entail extra burden and costs on industry, especially utilities and automotives and large industrials. But nonetheless, we believe that this is something which is now firmly embedded within the EU policy framework and is unlikely to move away. If you move to the next slide, please. So what does this mean in terms of the taxonomy? Well, you may have come across the term taxonomy many times in terms of the classification system which the EU has put in place for sustainable economic activities. And essentially, a taxonomy is really a way of trying to define what is green and what isn't green. And there are essentially 6 different high-level objectives under the taxonomy. I won't go into too much detail now, but they relate to around climate change, mitigation and adaptation, sustainable use or pollution of water, the circular economy, biodiversity, pollution control, and higher healthy ecosystems. So those are the 6 environmental objectives as defined in the regulation, and those form the basic framework of the taxonomy. So everything that is being put into financial instruments is going to be classified or need to be classified according to the taxonomy and reported on. And this is something which is now firmly in the legislative agenda and moving forward, so that we are now seeing that by the end of this year, the taxonomy will be established. By the end of next year, there'll be full application of the first 2 objectives for climate change, adaptation and mitigation. And by the end of 2022, full application will be expected. One of the important things about the taxonomy is not just the environmental objective, but also the concept of doing no significant harm. So you may sort of have an investment in a renewable energy project, for example, but if that is causing other negative side effects on the environment, could be pollution, could be on the biodiversity and where the plant is built, that could fall foul of the taxonomy. So it's quite a broad-ranging set of principles. So we go to the next slide, please. So the taxonomy itself, and we've published a fair amount of research on this topic, is, as I say, it's a common language for finance professionals and companies that are wishing to raise finance. It's stressing the economic importance of green activities. And essentially for institutional and retail investors, it helps them identify the opportunities that they have for basically maintaining sustainability in their portfolios and monitoring the impact. The idea behind it was to try and counter the threat or the reality, in some cases, of greenwashing by having a common harmonized standard and also align the European Union with the 2015 Paris Agreement goals on climate change, as well as the United Nations Sustainable Development Goals, which are now firmly entrenched within the financial system. So investors are expected and are gearing up to using the taxonomy's criteria to screen investments. And so this is basically now fairly much becoming mainstream, and the financial world is adapting to it. So if we move on to the next slide, in terms of the greenhouse gas emissions trajectory. So, we are seeing, the current COVID-19 pandemic having quite a severe impact economically as a fall of output, industrial output. And as you would expect, there is a connection between output and greenhouse gas emissions. And this is a projection that we put out in our report to show that, Q2, we expect a significant drop in emissions. But in fact, that drop could be as far as 14% relative to last year in the same period. But we expect that to increase back up to near where we started at the beginning of the year by December. Now, that forecast in itself does depend on a number of factors, and these are important factors to bear in mind. And so if we move on to the next slide. So emissions, they have followed a kind of a trend over the past few years of being linked in terms of the volatility and trajectory along the lines of GDP growth. And as you can see, this chart here shows you how that trend has borne out. But one other thing that we're noticing, and we've mentioned this in previous reports related to the EU Green Deal, is that there is generally a decoupling between economic growth and resource use. And what that means is basically that you could see an increase, and we have seen an increase in GDP without necessarily the same increase in emissions. And that's important because the EU Green Deal is premised on the fact that you can actually green the economy without necessarily causing economic hardship. And that remains firmly one of the key principles of the European policymakers, that you don't have to see a rise in pollution as a necessary evil of growing the output and recovering back to where you were before. Because if that were the case, then essentially the EU Green Deal would not work. So we move to the next slide, please, number 9. So in terms of what this means for climate policy, so despite there being some pressure from some politicians, mainly from Eastern Europe, the Czech Republic and Poland, mainly, to try and slow down the pace of policy, to maybe postpone some of the Green Deal and sustainable finance objectives, we haven't seen that being a majority position being taken. So as a whole, the European Union is standing strong. We feel that the emissions reduction target for 2030, that ratchet up from 40 to 50% remains in place, and it's going through public consultation at the moment. And we also see that there are some countries that, such as the Netherlands and Germany, for example, that are pushing ahead with their plans to impose carbon taxes and bring in more measures to expand the sort of the cost of carbon and the incentives that brings to gearing the economy towards net zero by making fossil fuel generation, fossil fuel industry far more expensive. So that policy objective remains firm in most countries. So from a macroeconomic standpoint, carbon taxes are still being favoured by the large portion of European nations, despite the fact that they're one of the only ways the Eurozone economy could actually try and ease the burden on the cost of economic recovery. So it's important that sort of countermeasure is still in place. If we move to slide 10, you can see here that the public and private sectors will continue to prioritize the recovery from COVID-19. That remains unquestionable. There will be the short-term focus will be to try and firm up workplaces, reduce the cost burden on companies, especially as many of them have been left with extremely weak balance sheets. We've seen numerous rating actions at S&P as a result of COVID-19, and this is going to be the focus of many people's minds. But nonetheless, people are always already looking forward to what happens after lockdown, and the longer-term issues such as climate change, which are seen as a systemic risk, will not be forgotten. in our view, and that's because climate change has been increasingly viewed as a big sort of systemic issue, which, like the pandemic, needs to be incorporated into current planning and also investment. Otherwise, it could be seen as another cause for economic downturn and shock in the same way that the pandemic has been. So we can move to slide 11. And this is an interesting situation because we are seeing some carbon-intensive sectors, automotives, for example, which have suffered extreme downturn in sales, put extreme pressure on the European Commission to slow down the Green Deal objectives. And the auto sector is responsible for 23% of greenhouse gas emissions over the period 2030, between now and 2030. The same goes if you move to the next slide on aviation. We see there's also been a substantial dip in air travel. In fact, something in the region of 70% drop over the past 2 months. And that's led to the aviation sector basically brought to its knees in most cases, as I'm sure you picked up in the media, with many companies going out of business or nearly going out of business. And then there's pressure leading to a reduction in the standards for emissions and also rebasing of the main trading scheme which the sector uses to make sure that it's not as stringent as it was before. So these kind of pressures will continue to be there, and we'll have to see how that pans out. But at the moment, we don't see that having changed the policymakers' long-term objectives. So if we move to slide 13, or next slide. So the energy transition in times of COVID-19, this is really related to the longer-term ambition. So going beyond the current crisis, which has led to a fall of demand by 20%, to the more medium and long-term energy transition plan, which is essentially to achieve carbon neutrality by moving away from coal and gas and towards zero carbon technologies such as wind and solar and other renewables. That, we believe, is going to continue as a priority. We know that there's going to be large-scale investments in the energy transition. There already have been. On a global basis, it's estimated that between 10 and 20 trillion dollars will be invested over the next 6 to 18 months to stimulate economies in light of COVID-19. And central bank and financial supervisors are pushing hard for that investment to be related to green investments rather than just mainstream business as usual investments, which could lead to a requisite or a usual rise in emissions. So that message is coming out very clear, this move towards green. So just finally, and I think I'm running out of time here, so I'm just going to say
actually,
that
Mike, we've got to we're going to extend for a few minutes. So okay. So I'll just finish off. How much time have I got? So I think we've got another probably 5 or 10 minutes. Okay,
great. So so the last few slides really relate to the sort of economic position related to where we are in the Eurozone. So I've talked a lot about carbon and emissions, and carbon prices are part of that picture. So carbon prices are in the European emissions trading scheme, whereby polluting sectors have to buy these permits to be allowed to emit greenhouse gases and can trade those permits. The price of those permits reflects the demand for them, as you would expect, but also are heavily correlated to industrial output. So as we've seen the fall in output in the pandemic, we've also seen a massive drop in carbon prices, and that's to be expected. That's the way the emissions trading scheme was deliberately designed to do that. But we're now seeing that the prices increase again to closer to where they were prior to COVID-19. So which suggests that there is a rebalancing taking place, and that the picture in the market is expected that we are going to see more and more demand for carbon allowances as industry ramps up again. So it's only a short-term phenomena from the carbon market point of view. So, and the next slide, really, just to finish off my comments, more on the macro side. Infrastructure investment, whether it's on power or transportation or on social infrastructure has been one of the key issues of the European policy domain for the past few years in terms of trying to stimulate growth. We've seen this through the previous Commission and the Juncker plan. We're now seeing it through the Green Deal. Transport infrastructure as a subsegment has been decreasing as a share of GDP, as you can see here. And so more investment in infrastructure is seen to be one way of trying to stimulate economic recovery, even pre the COVID, and especially now during COVID, we would argue that's the case because of the multiplier effect. So $1 spent, or €1 spent, I should say, on infrastructure has a greater multiplying effect on GDP growth than many other areas. And that, the last slide I'm going to show you is to say that from that perspective, the European Union has really been lagging. As you can see here, France, Germany, Italy, Spain have really sort of not invested that much in public investment, and that's a proxy for infrastructure, really. And it has been back to pre-2007 levels over the past decade or so. So there really is a case to ramp up infrastructure investment, the multiplier effect. Key thing here is that that industry and stimulus will be towards the Green Deal objectives in terms of meeting climate objectives and the climate goals. And so that will, in a sense, continue to be the case, despite the fact that there will be significant activity. But at the same time, we feel that the overarching ambition remains strong for achieving carbon neutrality by 2050. So those are my comments. I'm just finished off there, and happy to take any questions you have for me.
So, Mike, one of the questions that I had was around social bonds. Last year, I know we had a lot of activity in the environmental space, and what I've been reading this year is there's been a lot more interest in social bonds, and it'd be great to get your views on how you see those two trends continuing this year.
Yeah, sure. Social bonds have really become very popular over the past couple of months. And no doubt that's because of the implications of COVID-19 and the need to redirect funding to social beneficial schemes such as healthcare, education, employment, and so on. And while for the past 5 years it's really been green bonds that have dominated the sustainable debt landscape, and there's now up to about 200 or 300 billion of green bonds are being issued every year. This year, we believe social bonds are going to be as popular, if not more popular, than green bonds, judging by the fact that over the past couple of months, at least, we've seen well over 30 billion of social bond issuance. Now, admittedly, a lot of that's from the multilateral banks and multilateral institutions such as the EIB and others. But we've now started to see some corporates and other non-financials coming into the social bond arena, and also the appetite amongst investors to buy these type of instruments has never been higher. So I think social bonds are now, the next or the new green bond, really. So
for those treasurers that have looked at whether they can issue green, come to the conclusion that there's very little business case for them issuing environmental bonds, do you think they should be going back to the table and talking to their advisors around issuing in the social bond space? Is that something treasurers should be go back to thinking about?
Well, I think a company needs to first of all decide if it can actually make any benefit from the use of proceeds market. So one thing, I mean, if you take the analogy with green bonds, you can only really enter the green bond market if you have projects which provide an environmental contribution, and so you can allocate funding towards those projects or assets. And the same goes for social. I mean, if you're involved in investments which have a social benefit, such as building schools or hospitals or healthcare facilities, or providing workforce or employment schemes, and your company is involved in that area, then it's it's something which should be investigated. But if you're not involved in that, then it's going to be kind of quite difficult to see how you can actually enter into the social bond market.
Sure, but I guess also as businesses start to rethink their purpose and rebuild their organization, maybe an area where they choose to participate more, and I guess there's also therefore funding available to help them re-engineer some of their business activities.
Yeah, I think this is all about transparency, really. If you are putting investments into projects which have social benefits, and you can clearly demonstrate and have the data to show what those benefits are, then that's going to be something which will be of interest to the investor community. There's clearly appetite out there to try and put money to work to rebuild the economy, but also to provide social benefits and healthcare, education, and employment. So if that's something which you can show that your investments are doing as a corporate, then clearly that would make sense.
And just as a final question, we talked about how ESG is going to remain on the agenda for a long time. And I guess given the amount of governments have made across the UK and Europe through various financing intervention programs, the governments will have a much role in terms of helping to support ESG frameworks. Does that then give you more confidence that we will be able to achieve the 2050 carbon goal objective?
Yeah, I think the policy frameworks which are being put in place at the moment related to ESG and sustainable investment will make it a lot easier for corporates to direct their financings to the appropriate areas, because there'll be clearer standards. The disclosure levels will be much more entrenched within mainstream financial reporting. For example, the Task Force on Climate-Related Financial Disclosure, which Mark Carney, your speaker tomorrow, is very much a supporter and actually instigated himself back in 2015. Those kind of frameworks, the Non-Financial Reporting Directive, which is now being revised by the Commission, all those ESG standards are now coming together and will make it a lot easier, we believe, for financing to flow in a way which is more transparent and consistent. I mean, there's still some way to go, because there is still a need for greater standardization of ESG data, but we are seeing very rapid movement in this direction, and things like the EU taxonomy are only going to help in that respect. And going back to your previous question on social, that's now being included by the EU in its taxonomy. So I think the ESG sphere is growing bigger all the time.
That's brilliant. Thank you very much for answering that, Mike.
That's okay. Pleasure.
Well, I hope you found this session useful as you look beyond the initial liquidity and business challenges of COVID-19 and consider longer-term issues such as ESG. There's a slogan heard quite often now, build back better, and however you define better, I'm sure ESG will be a part of it. Thank you very much for joining this session, and we'll be continuing the conversation, so please do join in. A reminder, you can chat directly with fellow attendees, and session along with all the others will be available on the web portal. Please take time to fill in the survey, and finally I'd like to thank Wilkins Global Ratings for sponsoring this event. I would like to make a reminder that we are creating a working group on EE. If anyone is interested in participating, please drop an email to technical@treasurers.org. And I'll just say goodbye, safe, and hopefully you'll join us tomorrow. We'll have a from Mark Carney, the UN Special Envoy for Climate and Finance. Thank you and good evening.